Lecture 1. Feeling at home in the financial markets.
Unfortunately, most of us don't have very good financial literacy. We just don't feel comfortable in the financial market in the same way we do in the goods market or the jobs market. Part of the reason for this is because we don't understand most financial products and services very well. And that's a real problem because some of our most important economic decisions involve financial products, like borrowing money to buy a house, buying insurance, or saving for retirement. We need to be financially literate so we can find the right kinds of products for us and so we can be able to tell whether we're getting a good deal on them. The other big reason why we don't feel at home in the financial market is that we don't have a very good idea of how the financial market works. For example, sometimes when the unemployment rate rises, the stock market rises too. How can that make sense? Do the financial markets play by a completely different set of economic rules? Well, you may think so, or you may be even tempted to think that they don't play by any rules at all. I agree that the financial markets often seem completely out of control. One minute, they're hitting new highs with no end in sight, and the next, they're melting down, taking the rest of the economy with them. Maybe you remember the internet stock boom of the late 1990s, which was followed by the crash of 2000. Or how about the real estate boom of the mid-2000s, which ended in a massive financial panic and the worst recession in 2 generations? All of us know that every market has its up and down cycles. Products and companies rise and fall. Sometimes jobs are plentiful and other times they're scarce. But for the most part, we have a good understanding of why these things happen. That's not the case with the financial markets. For most of us, it's not clear why they swing from boom to bust so unpredictably. And when they do crash, they can destroy huge companies and wipe out the life savings of millions of people at once. So, given their complexity on one hand and their seemingly dangerous unpredictability on the other, I wouldn't be surprised if you don't think it's even possible to feel at home in the financial market. And yet, I think that financial literacy is not only possible, it's actually a lot easier to achieve than you think. I want to show you that the financial market really does play by the same economic rules that apply to every other market. I'm not going to claim that you or I will ever be able to predict what the markets are going to do next, but we will discuss the concepts and connections that will help explain why things happen. And we'll learn about the main financial instruments that everyone needs to be familiar with. I'll show you some simple and powerful ways to understand financial markets and instruments that will help you make sense out of all the apparent confusion. The best way to start building up our financial literacy is to answer a simple question. What do the financial markets do for us? I realize this is actually a controversial question. A lot of people are convinced that financial markets don't do anything productive. They only exist to help a few privileged insiders get rich. Well, is that the case? It is true that the financial markets have helped a lot of people get rich, but not just bankers and money managers. The financial markets have made it possible for entrepreneurs like Steve Jobs to get rich, and millions of small investors who bought the shares of companies like Apple and Microsoft too. The financial markets play a key role in building up and maintaining the production of all goods and services. In fact, it's hard to think that we could have our modern economy with its huge diversity of products without the financial markets. So let's take a detailed look at how the financial markets facilitate and support that economy. An excellent breakdown of what financial markets do was created by financial economists Merton and Bodie. These economists describe 6 basic but essential jobs that financial markets perform for our economy. They refer to these jobs as functions. Every financial transaction or product is trying to do at least one of these jobs or functions, and in many cases, a single financial product will be doing more than one of these 6 jobs at once. Well, here they are. First is transferring resources across time and space. Second is pooling resources and sharing ownership. Third is discovering financial prices. Number 4 is dealing with information problems. The 5th is clearing and settling payments. And finally, the 6th is managing risks. The first job of the financial markets is transferring resources across time and space. This function includes many of the most basic activities in the financial markets, such as borrowing, lending, saving, and investing. Individuals and businesses alike often need to transfer resources like money across time so that they can afford to buy expensive items now rather than having to wait and save up the money. For example, suppose you're 25 years old, you're earning $45,000 a year, and saving $3,000 a year. Suppose you want to buy a $150,000 home. Well, without the financial markets, you'd have to put $3,000 into a sack each year and hold on to it until you had enough to pay for the house. Even if you earned good raises each year, it would still probably take you 30 years or more to save up enough money to buy the house. But because of the financial markets, you can save up a down payment within a few years, borrow the rest of the money, and be a homeowner by the time you're 30, rather than waiting until you're 55 or 60. Does that have a real benefit to you? Of course. And it also has a real benefit for the person you bought the house from, too. When you borrow, you're moving some of your future income to the present. You're able to buy something now, but in the future, that part of your income that you would have saved will belong to the person who loaned you the money today. That's why we say that the financial markets are transferring resources across time. And in order for you to be able to transfer money across time, somebody else has to lend you the money now. That's why we also say that resources are transferred across space. The people who lend you the money may live across town or in places like Germany, Australia, or Brazil. Another big reason for needing to transfer resources across time is that our income and our expenses don't usually match up exactly. For example, most of us plan to retire by the time we reach age 70 or earlier. After we retire, our income will be a lot lower than it is while we're working. So we want to transfer some of our income to our future retired selves. Without financial markets, again, we'd simply have to stuff money in a sack and hope that it doesn't get lost or stolen. And that we don't give in to the temptation to spend all the money now on fancy cars and luxury cruise vacations. Because of the financial markets, we can deposit the money in a bank or buy other kinds of investments that will not only be safer than hoarding cash in your home, but will hopefully also earn a good return. Businesses and governments have exactly the same need to transfer resources across time as individuals do. They want to make big investments now, like building factories and roads, but don't have enough cash on hand to pay for them. And they also have big mismatches between revenues and expenses. For example, retailers like Walmart have huge sales increases at Christmas time, but then sales will be much lower during the rest of the year. Their expenses, meanwhile, will be much steadier throughout the year. So Walmart has to find some good way to transfer the extra money it makes at Christmas time to the other times of the year when sales may be below expenses. The financial markets provide a safe and convenient way to do this through borrowing, lending, saving, and investing. Without the ability to transfer resources across time and space, notice what happens. First, people and businesses have to save up on their own for any big projects they want to invest in. Piles of money will sit around in homes and offices, doing nothing but gathering dust and attracting trouble. This slows down economic growth because everyone has to wait for weeks, months, or years before they have enough money on hand to start a new investment. Also, everyone runs the risk of going bankrupt simply because their incomes don't exactly match their expenses at all times. Without financial markets, the only defense against this problem is to accumulate sacks of money and keep them on hand. Again, this slows down economic growth and forces everyone to waste money on keeping their own money safe. The next big job that financial markets do is to pool resources and share ownership among groups of people. This job is critical for the modern economy because the factories and equipment that we use to make our goods and services are incredibly expensive. In the old days, most businesses were family-owned and operated. A single family could afford to buy the tools and equipment it needed to start a business, or even build a small factory. And the profits from the business were often enough to enable the business to expand as needed. But as the economy grew and its products became more sophisticated, fewer families could afford to build the larger factories or to buy the expensive machines that were needed to produce goods efficiently. They had to pool their funds with other people in order to start a business or to afford the investments that would keep them in business. Today, the only way that our society can afford to build a new billion-dollar microchip factory is for thousands, if not millions of people to pool together their savings and invest it as a group. And when we invest with other people as a group, we need some kind of an arrangement that spells out who owns what and how the profits or losses from the investment will be shared. Stocks, bonds, and other financial instruments serve as these written agreements. An example will help show you what I mean. Suppose I have an idea for a new type of crunchy snack food made from turnips. Sounds great, right? I need $10 million to build the production facilities, run a marketing campaign, and manufacture enough of the new snacks to put them on the shelves in 10,000 stores across the country and start selling. I have some money to invest in this project, but I don't have $10 million. I could try to borrow the money, but trying to borrow the entire $10 million from one investor is probably going to be a tough sell. I could try to find, say, 1,000 investors who are each willing to lend me $10,000. These investors would be pooling their money together to fund this project. If I'm going to be asking 1,000 different people to lend me money, then I'll need to keep the lending arrangement simple. Imagine what a headache it would be if I had to sit down with each individual lender and negotiate a separate loan with its own interest rate and different payments. What I do is have all the borrowers agree to the same terms. I make 1,000 copies of a loan agreement that says I promise to repay the $10,000 at some specific interest rate, say 5%, over some amount of time, say 3 years. Because I make the same deal with each lender, everybody knows that they're being treated equally. That makes the lenders more willing to pool their money together in this way. So the standardized borrowing agreement, a bond, which we'll learn a lot more about in future lectures, makes it possible for the 1,000 lenders to pool their resources together and get this investment project off the ground. Well, instead of raising the $10 million for my project by borrowing, I could form a company and issue stock. Suppose I issue 10 million shares and sell them to investors for $1 each. Each share is worth 1/10,000,000th of the company and is entitled to 1/10,000,000th of the profits that the company earns from all those crunchy turnip snacks it sells. If I sell all 10 million shares of the company, again, I found a way to get a lot of different investors to pool their resources together in order to undertake some project. In the case of stock, though, the investors aren't just lending to me. They're buying ownership in the company that I formed to make and sell the crunchy turnip snacks. So the people who buy stock in a new company are pooling resources and sharing ownership of something valuable at the same time. That's why these two tasks go together. For many financial instruments, they're two sides of the same coin. The next job, which is number 3 if you're keeping count, is price discovery. The financial markets discover or set prices. Well, all markets set prices, so which ones do the financial markets set? Why is that such a big deal? The financial markets need to find the right prices for the jobs that they do for us. Remember that the first job of the financial markets that we learned about is to transfer resources across time and space. That's a useful service, right? Well, what's it worth to be able to do that? We need a way to figure that out. Think about using a bank loan to transfer resources across time. One way to think about the interest rate on the loan is that it's the price of having the bank make that transfer for you. We need to find the right price for this service so that neither too much nor too little of it is produced. The financial markets find that right price. And for some types of financial products, they do it in pretty much the same way that other markets do, supply and demand, with the producers of the service playing the role of suppliers and the users of the service playing the role of demanders. On a larger scale, think about how important it is for the overall economy to find the right price for borrowing and lending. Earlier in this lecture, we learned that transferring resources across time is directly connected to the amount of investment that goes on in the economy. If the price of borrowing and lending is too high, we don't invest enough, and economic growth will be lower than we want it to be. If the price is too low, we can invest too much, which can also cause big problems in society. Many financial crises, including the most recent one, are caused by an inability to find the right prices for financial products and services. One of the main causes of the financial crisis of 2008 was that loans were simply too cheap. So too many people took them out and then couldn't pay them back. Now, I realize that in my discussion of these first 3 jobs of the financial markets, I've suddenly introduced stocks, bonds, and bank loans without really explaining them in detail. Please don't panic. I'll get into lots more detail about these instruments and many others too. The reason I brought them up just now was to give you concrete examples of the tools that we use to carry out the jobs of the financial markets that they do for us. In fact, for the rest of this lecture, we're going to learn about some of the most basic tools that are used in financial markets. This will help us understand exactly how the financial markets do all the things we ask them to do. By far, the most important tool in the financial market is the contract. When people lend money to each other, or buy stocks, or engage in just about any financial transaction you can think of, there's an agreement involved, a contract. For simple transactions, the contract may be informal, like a quick verbal agreement. All of us have had a friend or a child come to us and ask something like, "Can I borrow $20 today and pay you back next week?" If you say yes, hand over the $20, you have a contract. But in general, there's going to be some written agreement, a written contract, behind every type of financial transaction. When you take out a loan from the bank, you have to sign a loan contract, and a representative of the bank signs it too. Making contracts and trading contracts are the concrete ways that financial markets carry out all the jobs we need them to. And as you might suspect, making contracts means that people who have conflicting agendas have to negotiate and compromise in order to reach an agreement. Think about a simple loan contract. If I'm a lender, I want to charge the borrower a high rate of interest. I want the money paid back soon, and I want to be able to look over the borrower's shoulder and tell him what to do. It's my money, right? On the other side of the negotiating table, you have the borrower. The borrower wants to pay a low rate of interest, and they want to have a lot of time to pay back the loan. And they don't want the lender telling them what to do with the money. They already know what they want to do with the money. Well, it's pretty clear that unless these two sides make some compromises, then they won't be able to make a contract, and the loan won't get made. Just about every financial contract embodies some significant compromises between the two parties. And from my experiences working with government officials around the world to help them develop their financial markets, I can tell you firsthand that the lack of ability or willingness to compromise on the parts of borrowers and lenders can be a huge obstacle to financial market development. So as we learn about financial markets and the contracts that the financial markets are built on, we'll also learn about the compromises that people are making in order to get an instrument or a market to work. As I said a second ago, behind every financial instrument lies a contract. In many cases, the financial instrument is the contract. In the case of a bank loan or a bond, the instrument is the contract. In some other cases, the instrument isn't the contract, but it's connected to a contract. I'll show you an example of that later in the course. This talk of contracts and instruments reminds me of a related term that we often use in the financial markets: security. A security is written evidence of the extension of a loan. Let me repeat that. It's written evidence of the extension of a loan. Again, this evidence is often the contract itself, as in the case of a bank loan or a bond. But the written evidence may take some other forms as well, and again, I'll show you examples of that later in the course. Now, a contract is nothing more than a set of promises. Each party to the contract promises to do something for the other. In financial contracts, the promises often have to do with making payments. Think about the simple verbal loan contract I mentioned a minute ago. If you pay me $20 now, then I promise to pay you back the $20 next week. As we'll see in future lectures, there are lots of other types of promises that also get put into financial contracts, and there are good reasons why they're in there. For now, keep in mind that financial instruments, as contracts, are sets of promises that two parties make to each other. Another aspect of financial contracts is that they're assets. An asset is anything that serves as a store of value. There are physical assets like land, gold bars, buildings, and factories. There are also assets that are intangible, but nonetheless real, like ideas, or a person's knowledge, skills, and experience, which economists call human capital. All of these things are stores of value. Financial instruments, securities, the written evidence of the extension of a loan, are also assets in their own right. They enable people to store value for later. That's what saving is all about. And most people save, at least in part, by buying financial instruments like bank deposits and mutual funds. We use the term financial assets, which distinguishes them from real assets like the ones I mentioned a minute ago, because they differ from real assets in a fundamental way. Real assets have value because we can use them to make things. But financial assets, remember, are just contracts, pieces of paper or computer digits that have no value of their own. Financial assets derive their value mostly from some real asset or assets that they're connected to. Financial assets, since they're based on contracts, are promises to pay money to the person holding the asset. But where does that money come from? Well, it has to be earned by some real asset that the financial asset is connected to. Think back to my example of the new crunchy turnip snacks. If you lend money to me by buying a bond, the bond has value because I've promised to pay you $10,000 plus 5% interest over 3 years. Where does the money come from to pay back the loan? Well, I'm intending to pay you back from the profits earned by all the real assets that go into this business venture. The idea for the snack, the production facilities, the buzz created by the advertising. All these things are real assets that these bonds are connected to, and they generate the sales that will provide the cash that will pay back the bonds. Well, hopefully. Similarly, when you and I borrow money from a bank, the loan has value to the bank because we're promising to make cash payments to the bank over several years. Where do we get the cash? Well, we earn it by using our own human capital to earn money doing some job. For every financial asset out there, there's a connection back to some real asset or assets. The connections may be pretty complicated, but they have to be there. Otherwise, financial assets wouldn't be worth anything. It's that connection to real assets that gives financial assets their value. In fact, a lot of financial crime takes place when a person falsely claims that they've discovered some magical real asset that generates returns that are too good to be true. The people running these schemes never divulge exactly what real assets are generating the returns. That's because there aren't any. This is the case in just about every fraudulent investment scheme, like the one operated by Bernard Madoff. Bernard Madoff was a successful securities dealer whose main business since the 1960s was trading stocks. In the 1990s, Madoff branched out into a new business, managing a hedge fund. Since Madoff had been a stock dealer for a long time, it seemed reasonable that he would know how to pick stocks and trade them profitably. And the returns that Madoff generated were amazing, not just because they were high, about 10 to 20% per year, but also because they were so dependable. Madoff's fund reported a great return no matter what happened to the stock market. Madoff wouldn't say exactly how he was able to pull it off, and actually made a big deal out of the fact that he used a secret trading strategy. But this only seemed to attract more wealthy investors. In addition, Madoff turned away a lot of people who wanted to invest in his fund, and that exclusivity made it even more attractive. By early 2008, Madoff was managing about $60 billion of other people's money. But after the markets crashed in 2008, Madoff made a dramatic announcement. His investment fund was a total fake. Instead of operating an investment fund, Madoff was running the world's largest pyramid scheme. In a pyramid scheme, one person's investments are simply passed on to pay off some other people who invested in the scheme earlier. Madoff's pyramid scheme collapsed, like they all do eventually, because it ran out of new investors to pay off the old ones. Bernard Madoff went to jail, and all of his investors lost nearly all their money. The moral of the story is simple. Before you invest, make sure the investments manager can show you the real assets. The example of financial fraud, which far too many people fall for, by the way, illustrates yet another reason why it's hard for us to feel at home in the financial markets. If you don't realize that financial assets derive their value from some connection to a real asset, it's hard to understand how to find the right price for a financial asset, and it's easy to be fooled. So it's not surprising that people feel uneasy when they have to buy or sell financial products. They're constantly worried they're being ripped off. In other markets, like the goods market, it's much easier to think about what the value of a product is, because you can use or enjoy these things directly, and you know how much they're worth to you. Even when you understand the connection between a specific financial asset and the set of real assets that give the financial asset its value, it's still difficult to know for sure what a financial asset is worth. That's because the real assets that give the financial asset its value are themselves hard to put a price tag on. Think about a company like General Electric, for example. This company makes a huge range of products from aircraft engines to light bulbs, and it has factories all over the world. How can we possibly put a price tag on all that? Well, we do it the same way we find prices for everything else. Let the market do it. In this case, though, we use the financial market to find both the price of the financial asset as well as the real asset that gives the financial asset its value. Here's how it works. Since the value of financial assets should be closely tied to the value of some set of real assets, finding the price for one should be the same as finding the price for the other, right? So we're free to use whichever market is more convenient for us. Naturally, it's much more convenient to trade shares of stock in General Electric than it is to trade the real assets that General Electric owns, like factories and machines. We use the financial market to simultaneously discover the price of General Electric stock and all the real assets that GE owns. In other words, the financial market is a substitute for the market for real assets. That should be good news for all of us who are uncomfortable with the financial markets. Financial assets really do have to be tied to real assets that we all understand. Things like factories, ideas, machines, and skills. But financial assets are more than just convenient substitutes for real assets. They also add value for society by performing additional services that raise everyone's potential to produce and create. And these services also increase our opportunities to enjoy the things we produce and create. These services are the 6 functions of financial markets that we've started to learn about in this lecture. We've discussed some ideas that should help you start to get a better handle on what the financial markets are all about. Financial assets are contracts that represent or are connected in some way to real assets. But financial assets also allow us to do things that we simply can't do with real assets. Things like transferring resources across time or sharing ownership of a company. These additional services that financial assets perform can add a tremendous amount of value to our economy and to our own lives. The financial markets try to make sure that financial assets are priced correctly and that they end up in the right hands. So how do financial instruments and markets live up to this potential? Why do markets sometimes fail to live up to their potential, or just plain fail? And what, if anything, can I, you, the private sector, or the government do about it? It's going to take the entire course to answer those questions. But it's easier than you might think to get started. All you really need to do is follow the money. And that's what we're going to do in this next lecture. So get ready, because I'm going to show you some serious money.